Welcome to the D-Risk Daily Brief. It's Wednesday, November 5th. Yesterday's sharp reality check on global growth has given way to a tense, uncertain calm. The theme today isn't outright panic, but a growing fear of policy paralysis. With the U.S. government shutdown now creating a dangerous data blackout and reports of a credit crunch emerging, the market is questioning if policymakers are flying blind straight into a slowdown. U.S. futures are treading water this morning, slightly in the red, but the real story is in the details. The VIX is holding firm above 19, a clear sign that yesterday's fear hasn't dissipated. The dollar remains the safe haven of choice, and bond yields are suppressed. It feels less like a directional bet and more like a market bracing for an unknown impact, unsure if anyone is truly at the controls. Alex, this feels like the market has moved from pricing a slowdown to pricing the inability to respond to one. How is this narrative of policy confusion shaping the global session, starting in Asia?
That's the perfect framing, Sarah. The core tension is policy divergence and confusion. Let's start in Tokyo, where the latest Bank of Japan minutes reveal a house divided. The hawks are pushing for an immediate rate hike, but the doves are hitting the brakes, explicitly citing the U.S. economic slowdown as a reason to wait. This internal conflict is preventing a strong rally in the yen, even as the Nikkei's bullish technicals are being tested by weakening regional fundamentals. That links directly to China, where we're seeing a clash between optimistic long-term rhetoric and the grim short-term reality. While Premier Li is projecting a massive economy by 2030, the real-time data from shipping and logistics companies continues to flash red on current demand. This creates a deeply confusing picture for investors trying to position for Chinese growth. This sense of uncertainty carried straight into Europe. The DAX and FTSE are still technically in uptrends, but all eyes are on the central banks. The Bank of England's rate decision tomorrow is now seen as a genuine coin toss between a hold and a cut, injecting significant volatility into sterling. Meanwhile, after the ECB's aggressive 200 basis points of cuts, the market is now trying to price in a turning point towards future hikes. So across the board in Asia and Europe, you have major central banks all at critical but completely different inflection points. And this all brings us back to the U.S., which is the epicenter of this policy paralysis. The government shutdown is no longer just a political headline. At 36 days, it's a severe economic drag, costing an estimated $15 billion per week. More importantly, it has created a data vacuum. Fed Chair Powell himself admitted it's like driving a car in the fog. This is happening just as reports of a short-term credit crunch are surfacing in the U.S. banking sector. This puts the Fed in an impossible position, and it's rippling across assets. In fixed income, the flight to safety continues, keeping the 10-year Treasury yield suppressed near 4%. The market is confused. Governor Cook is signaling the easing cycle may be over, while the White House is publicly pressuring for more cuts. In that environment, you buy bonds. In FX, capital is flowing to the dollar as the cleanest, dirty shirt. The DXY is holding firm above 100, not as a vote of confidence in the U.S., but as a flight to liquidity when every other major economy's policy path is equally opaque. This strong dollar is a major headwind for commodities. Gold has decisively failed its attempt to hold the psychological $4,000 level, and crude oil is getting hit from both sides. The strong dollar makes it expensive, and last night's API report confirmed a massive 6.5 million barrel inventory build, which screams demand destruction. WTI is now struggling to hold $60 a barrel. Finally, the VIX tells the whole story. It isn't exploding higher like yesterday, but it's stubbornly elevated above 19. This isn't the price of panic. It's the price of deep, profound uncertainty. The market is paying up for protection because right now, nobody knows what the policy playbook is. Back to you, Sarah.
So the market is trapped between a tangible global slowdown and the paralyzing uncertainty of the policy response. In this data vacuum, today's private sector numbers become absolutely critical. The ADP employment report will be the market's first real, albeit imperfect, look at the October labor market. Following that, the ISM Services PMI will be the main event. We already saw the manufacturing PMI show a deeper contraction, so any sign of weakness spreading to the much larger services sector could amplify recession fears and put the Fed in an even tighter spot. We'll also be watching the official EIA report on crude oil inventories to see if it confirms the huge build reported by the API, which could send oil prices even lower. And looking across the Atlantic, a speech from the Bank of England's Breton will be scrutinized for any last-minute hints ahead of tomorrow's nail-biter of a rate decision. It's a day where the market is desperate for clarity, but the fog of the government shutdown means it's unlikely to get any. We'll leave it there. Thanks for listening to the D-Risk Daily Brief. Disclaimer, this podcast is for informational purposes only and does not constitute financial advice. All investment decisions should be made with the help of a professional.